Well, guys, Ferrari is down big. This is a company that I love because of their exclusivity, the luxury of it. They could sell 100,000 cars a year. They just choose to sell 15,000 cars a year, but it's down big, about 14.8% today so far. Got as low as 16%. And the reason being is their guidance, which I think is hilarious because who the hell cares what Ferrari is guiding? Literally, who cares? They're an exclusive brand who's just trying to sell to the elite of the elite, and that's it. So if they guide, I don't even know why they even offer guidance. I think it's absolutely ridiculous. Guys, this is our Everything Money Plus channel. If you're new to it or watch it regularly, do me a favor. If you're interested in earnings updates, if you're interested in news about the markets, if you're interested in analyzing individual companies like we're going to today with Ferrari, do me a favor, subscribe to the channel. I think you're getting a lot of value out of it. It's different than our main channel. But this channel is for more in-depth and understanding and talking about ideas. So back to Ferrari. Here's an article about Ferrari that I want to show you guys. So net revenue is expected to be around 9 billion euros in 2030. They're talking about 2030. 2030, 4.5 years from now. Their guidance there was ridiculous. Now, before, they said that they were going to have about 40% of their cars by 2030 be electric. They've now altered that to 20%. Now, the reason this matters is, if you guys recall, in a lot of our videos in the past talked about electric vehicles, we said electric vehicles are absolutely changing the way in which we drive. But remember, things can still happen. And you saw the surge to electric vehicles, and now it's starting to pull back quite a bit. Is this a permanent thing? I don't know. I still think electric vehicles are the future. I love electric vehicles. I think they're awesome. But the fact that we're sitting here still talking about Ferrari, a car company that bragged about its motors and its engines, and all of a sudden now they're pulling back and cutting it in half, that's kind of interesting to me. So like I said, now in a separate update, Ferrari said it would target a 2030 sports car model lineup made of 40% internal combustion engines, 40% hybrid, and 20% electric vehicle, which is down from the previous 40% EV sales, like I talked about before. These are several global car makers have scaled their EV sales targets in recent months, citing factors such as lack of affordable models, a slower than anticipated rollout of charging points, and intense competition from China. Sweden's Volvo abandoned its heavily promoted plan to sell only EVs by 2030. My point isn't that, I told you. My point is to sit there and say, guys, stories change. This is why we talk about letting us decide, letting us look at the long term of the story. What's the long term of what this means? Whenever a company is doing something, don't just, if they're so quick to change something to electric vehicles so quickly, it can change back very quickly. We're looking at the long run. Can Ferrari build a great car? Absolutely. Whether it's electric vehicle or internal combustion engine, will they build a great car? Absolutely. So if you're a buyer of Ferrari at $500 a share, then you better believe you should be a buyer of Ferrari today at $408 a share. It's $70 lower. It's 15% lower today. But the question becomes, is it really worth that? So let's look at some of these metrics here for the company. $73 billion market cap. One thing I love about the company is their free cash flow is a lot closer to their net income now. Before, it was like half. We don't want it to be half. We want it to be within 20% on the high side. It's now within 20% on the high side. Because you look at their 5-year free cash flow, it's very different than their 5-year net income, but it's getting closer. Another thing, great returns on capital. This means this is a premium company. 17% in the last 5 years, 21% in the last year. This means this company is a great company. Gross profit margin, 51%. Guys, the typical car company is 15 or 20%. Ferrari makes 51% of every car it sells that gets added to the bottom line. That's why this is a premium car company. That's why this is a luxury brand. This is what's important to understand. Bottom line margin, getting better and better. 23% in the last year, 21% in the last 5 years. So it's getting better as time goes on. You still have this earnings price to free cash flow of 46 and PE ratio of 39. Now let's check out the 8 pillars right here. We've got all check marks except for valuation metrics. Revenue growth, net income growth, cash flow growth. The debt's actually higher than I think it lets on. $73 billion, it's really not a ton, but you got to remember their free cash flow is still lower, and it's going to keep growing and probably get higher and higher. That's what's important to remember. They bought back a few shares. When the company's selling for 40, 50 times free cash flow, is that a good thing? I don't exactly think it's a good thing. Let's go to analyst estimates. 1044 a share this year, going to 1444 in the next 4 or 5 years, growth of about 40%. Revenue growth, 7, 11, 7, 9, and flat. So high single digit. But remember, Ferrari could increase their revenue tomorrow by 20% by selling more cars. They choose not to do that. They choose not to sit there and just be another automaker. They want to be elite. They want to sell to the few of the few. They want to do that over and over again. So the question becomes, what is the right price to pay for Ferrari? That's always the question we have whenever we analyze any company. So that's why we have the stock analyzer tool. This allows us to take the story and the numbers and put them together. Now, there's a reason why this tool is used over 1 million times per year by our users. It's because it allows us to come up with a price to pay for a company based on our assumptions. That's what's really important. All the stuff you talk about, is it a great company? Yes. Is it growing? Yes. Is it elite? Yes. Great. So what's the right price? Well, if you remember, every time you buy an investment, your return's going to be based on all the cash flow you get in the future. That's what the stock analyzer does. It says, okay, what's the revenue growth going to be? What's the free cash flow and profit going to be on that? What's the company going to sell for 10 years from now? And what return do you want? It tells you all based on those numbers what price to pay. So let's pull up the last time I did Ferrari. When was it? Okay. I did 10-year analysis. I did 4, 7, and 10% revenue growth. I said high single digits for the next 4 or 5 years. So this seems about in line there. Now, obviously, I don't know what they're going to do, but it could be they could all of a sudden unleash more cars because they don't sell a ton of cars right now. And Africa is growing like crazy as their fastest market of growth. And as Africa gets wealthier and wealthier, it's going to continue to grow even more. So I think I'm fine with that for now. But I understand if you put a higher number in there. Profit margin, 19, 20, and 21. I should probably go higher here. I should go 19, 21, and 23. And now that their free cash flow is getting closer, I'm going to put the same free cash flow multiple in there. Now, what PE and what price to free cash flow would you give Ferrari 10 years from now? So remember, this is where I look at it. The market average is 15 or 16. You go higher for better companies with more growth. You go lower for worse companies with less growth. This is a great company with decent growth. So what's the right premium? Well, remember, when Warren Buffett bought Coca-Cola in 1987, he paid 30 times earnings. Is this a better company? Is this more of a moat than Coca-Cola? I don't know. I think so. And you're only selling the elite. I look at it going, yeah, could I understand a higher multiple than that? Yeah, I put in 22, 26, and 30. Sounds like a lot, but this is a company that is going to be around for a very long period of time. And even if we have recessions, the people who afford Ferraris are people who are usually not as affected by recessions. So I think it's kind of like a very safe company in that regard. And of course, I do my 9% desired return. Why 9%? Well, that's the market return. So if I put 9% in there, I'm basically getting my intrinsic value. What's the company worth based on the market? Now, I will not buy Ferrari based on the market return. I want a margin of safety. So for those of you out there who are putting Ferrari in your stock analyzer, put a higher number than 9% in here. The more desired return, the lower the price, right? Now, if you don't have stock analyzer, I highly recommend you take a look at it. Guys, this software is something I use every single day. All my staff uses it. I use it for all my investing. I created it for me, and we created it for users because people kept asking, how do I get that software? So if you're interested in upping your investing game and looking to learn, we're not looking for people who are trying to get somebody to give them fish. Somebody who's wanting to learn how to fish, click the link below. We have a 7-day trial. Check it out. It's a great way to dip your toe in and see if it's the right software for you, but it's definitely going to make your investing decisions much better and easier. I hit the analyze button. So based on these assumptions above, I have a low price of 180, high price of 440, and a middle price of 280. So if I want margin of safety and put a 12% return in, I have a low price of 144, middle price of 225, high price of 334. So I'm adding to my watch list at 250. That way I can take a look at it, and the software and the app will send me an email saying, hey, Ferrari hit 250. So guys, appreciate you watching this video. Do me a favor, two things: subscribe to the channel and check out our free trial, not a free trial, our 7-day trial for our software. Thank you for your time.